What is Warren Buffett's approach? How does Warren Buffett approach investing? Value investing has gained popularity thanks to Warren Buffett. By ably managed businesses, in whole or in part, that possess favorable economic characteristics, is the investing strategy advocated by Warren Buffett. We also examine his portfolio and investing history. Be fearful when others are greedy. Be greedy when others are fearful. According to this quotation, a recession or a significant decline in the market are the ideal times to invest. Both the economy and the stock market follow business cycles. A boom always comes after a bust, and vice versa. There is a recovery following each notable market decline, and eventually the markets hit a new high. Consequently, investing during a significant market decline or bear market yields positive returns during the subsequent bull market. Therefore, while others are afraid amid a significant market decline, act greedily, and make investments, according to Warren Buffett. In a similar vein, a lot of people increase their investments during a bull market in the hopes that they will rise steadily, but you should be wary of the fundamentals and prices at these exuberant moments. Should they be stretched, it is best to sell and record the profit. Thus, in a bull market, Warren Buffett advises being afraid of others who are avaricious. Although Warren Buffett's advice makes sense, it can be challenging for investors to know when to buy in a down market and when to sell in a boom market. It's definitely not the best idea to try to time the market. Renowned investors with decades of experience in the financial markets include Warren Buffett. They have made a fortune for themselves and their investors and have extensive knowledge of the markets. Therefore, the whole financial community listens intently to these renowned investors when they talk. In actuality, a great deal of investors have made fortunes for themselves by only heeding the counsel of these illustrious financiers. In 2024, are you about to embark on your investment journey? Warren Buffett warns of a coming financial storm and stresses the value of planning ahead and being proactive in order to be ready for difficult times. Many people shudder when they think about the financial storm that Warren Buffett seems to be hinting about. Buffett is known as one of the most successful investors in history due to his ability to foresee market movements. Technological developments have the potential to upend established company models and produce winners and losers in the corporate sector. Buffett's techniques offer a roadmap for not just surviving but prospering in the face of financial adversity. It's not about escaping the storm, but rather knowing how to sail through it. Reducing debt and establishing a strong savings plan are essential tactics for navigating any financial storm. In 2024, Warren Buffett predicts a financial storm, highlighting the significance of being proactive and strategic in anticipating difficult times to come. Prioritize long-term investments in reliable, value-driven businesses. Diversification is important, but don't let it come at the expense of knowing what and why you're investing in. Being organized is the best defense against any storm, so begin making plans now to ensure your financial security tomorrow. Through his holding firm, Berkshire Hathaway, the well-known investor Warren Buffett has amassed a fortune of over $120 billion by purchasing companies and selecting profitable stocks over a long period of time. However, selecting specific equities is not a prerequisite for success in the stock market. Selecting stocks over the long term can be quite taxing, as emotions and volatility can challenge even the most composed individuals. Alternatively, think about applying Buffett's guidance to turn 2024 into your best fiscal year to date. During the peak of the epidemic, at Berkshire's 2020 annual meeting, Buffett remained steadfast in his fundamental investment philosophy. In other words, America is a financial miracle that has consistently triumphed over adversity to develop and flourish over time. He was accurate. The brief recession brought on by the epidemic has not diminished the size of the U.S. economy. For the majority, it's much simpler to get on board and appreciate the trip than it is to sort through thousands of publicly traded companies in an attempt to locate the ideal one at the ideal cost. Buffett has continuously pushed for the purchase of inexpensive index funds that follow the S&P 500, a collection of 500 of the biggest publicly traded firms in the United States. It is the widely accepted benchmark for the stock market and has a lengthy history of generating returns of 10% on average per year. In a 2013 shareholder letter from Berkshire, Buffett informed investors that he had given the trustee of his wife's estate instructions to invest 90% of it in S&P 500 index funds and the remaining portion in short-term government bonds. Since the market indices have reached all-time highs and the new year has begun on a bright note, most investors are eager to learn about investment opportunities from friends and family, while others are attempting to make sense of the market's volatility, which Benjamin Graham dubbed Mr. Market. As some industry titans like Warren Buffett have stated, mastering the ins and outs of the business is not necessary for most people to succeed. Instead, understanding the fundamentals is all that is necessary to make money. These are the 6 most important investing lessons that Warren Buffett has to offer this year. Ignore the trees and concentrate on the forest. He stated in a 2018 letter to shareholders that rather than concentrating on the specifics of the numerous and varied businesses the firm may be operating, investors should look at the big picture. If everything is going well in the group, you don't need to assess the future potential of your investment by looking at each tree separately. Pay attention to earnings rather than adjusted earnings. He brought up the fact that some businesses provide adjusted EBITDA rather than EBITDA in order to omit a number of expenses. Managers may argue, for instance, that the stock-based compensation offered by their company is not an expense. He quotes Abraham Lincoln on this subject, asking how many legs a dog has if its tail counts as a leg. Because, as he stated in the 2018 letter to shareholders, calling a tail does not make it one. Having a lot of money keeps you secure. He mentioned having an abundance of money to deal with any future emergencies. He said that a significant number of treasury bills and other cash equivalents are held by his company, Berkshire. We consider a portion of that stash to be untouchable, having pledged to always hold at least $20 billion in cash equivalents to guard against external calamities, he stated. Must invest, and then leave your money alone. According to Buffett, only a select few are emotionally and mentally suitable for investing in stocks because they are not short-term funds. The economy is a dynamic system. Interest rates fluctuate. The stock market is impacted by other factors. If you can't let your money alone, don't invest in stocks. That's all for today. If you like this video, please give us a thumbs up. Make sure to subscribe to our channel and hit the bell icon to receive notifications. Also, express your valuable thoughts in the comment section below. Until then, bye. Also, spend some time watching other videos on the channel.